Good afternoon, everyone. Happy Sunday. Happy Mother's Day. We're going to go through a couple different charts here for the week ahead. And as always, common sense technical analysis here. Let's just break things down as simply as possible. So we're going to start out, as always, with the SPY daily chart, the S&P 500. If we take a look here, we're just going to draw a Fibonacci retracement from high to low, right? And as you can see, we've been hovering below the 50% retrace on the Fibonacci, which is about 414. And we're just eating time off the clock. And obviously, everyone's looking at this range, just wondering when the hell it's going to get out of it. And I believe if we break above, we're going right for that 430 level, which is the 618 retrace. It also coincides with a couple of gap fills in the daily chart. And if we go down, it's this simple. We're going to go probably retest 398, which is the 382 retrace. Also coincides with the 100-day period moving average, which it has not satisfied for a while, as well as the 200-day period moving average. So there's certainly a case where, we get some type of nuke in the southern direction. And I also want to show you something interesting. If we draw this and look at it like this, so you have a deviation here, but what happened was it came into this channel, it found resistance, broke out, came down, found a little bit support, resistance, came down, again, resistance, came down, touched it perfectly. And now what's going to happen is if we come down into all these moving averages one last time, and I do think it's not just Nuke City from here. I don't think we're just going to go down in a straight line. I do think if we come back down, we're coming back down to retest the 398, which is that 382 retrace level, and we could possibly get this deviation one more time, similar to like we did right here, and then we will come back up into this channel and mess around before we go and satisfy those upper levels. Now, excuse me with this brush. I just want to get this this video out quickly today because I'm like to spend some time with the family. But anyway, again, I think if we come down, we could come and nuke down into this area, which would satisfy the 236 retrace, which is about 380 on the SPY. Now, that is the extreme scenario. I don't know if it gets there, if that happens. I think the more likely scenario is, again, we come in and we come and retest this 398 and this 382 retrace level, which also coincides, again, with that 200 period moving average, that green line. So those are the major master levels, as I like to call them, just common sense stuff, guys. And this is where I do have some shorts on the QQQ, which we will get to in a second. But if it comes up and I'll start building a nice short position, if it would start filling some of these gaps, and as well as if we get into that 618 retrace, even above, I'll leave room to build more shorts if we deviate out of this area and we come into what I like to call the breakdown box. We had a big breakdown area right here between the 618 retrace and the 716, which is right at about 436 on the SPY, up to about give or take 446. So it's about a $10 zone. So if we come up into that, those are all just short building material levels. So I'll be doing that, guys. And excuse me again, let me just get rid of this real quick. So that's my my major the major areas to look for on the S&P 500 moving into this week, moving into next week. Even we'll probably do the same thing next Sunday as well, because I just don't know if we're going to be breaking out of this range anytime soon. It really should. Let's do a quick candle count as well. If we're doing a candle count on the S&P 500 from the last major breakup, so this is what I would call the last major breakup before we started getting into this choppy zone, which was Friday, what is it, the 31st of March, and that was right before we got into April. So all these candles, if we count them, we like multiples of 7. We are at, I believe, 28 or 29 right now, so we're past the 28 multiple of 7. I believe that if we get into the higher range of this level, and let's call it like 35, 35 will be an important candle count. And we'll look for a sign or signal of a trend change, just like this one on Monday the 1st. That is an important kind of sign or signal of a trend change pointing to the downward direction, which it did happen. It just did not happen on volume, so I didn't really love it too much. But if we start breaking above, we break above, and we get into, again, that right now I'm going to ignore the 420, but I'm going to say 425 to 430, all the way up to 440 on a deviation out of this channel. If we get into that, I'm going to start building some shorts and looking for that 35 candle count. Because, I mean, we've been building a lot of energy here. I don't think that move up is going to be very subtle. I think that move up is going to be pretty quick, just like it should be quick to the downside, because we've been just chopping around and building energy to move either in the southern or northern direction. It's not rocket science. It's just where are you going to put your chips? For me, I'm not putting really any chips anywhere right now. I'm waiting for either the north side or the south side to play a counter trend trade. Okay, so that's pretty much it on the S&P 500. On the QQQ, so the QQQ, the NASDAQ, they have been a lot stronger lately. They are in a more bullish position. So if you just take a look at it, let's just get rid of these drawings right here. If we just look at it from a simple, daily moving averages perspective, the SPY has been hovering around and chopping in between the 20 period and the 50 period moving average. And the NASDAQ, the QQQ, is well above the 20-day period moving average and well above the 50, 100, and 200. They are both pretty much right at or below the 50-day retrace, or the 50% retrace on the Fibonacci. So nothing too much there. However, the daily moving averages, again, is kind of telling you that risk is definitely out there. People are taking risk. People have been taking risk. So again, there might be upside here. If the SPY breaks out to those next areas, like I said, the 430 to 440 zone, I think the QQQ will easily satisfy the 618, which is at 350. And same goes for the downside, right? So you're going to have more volatility in technology if we get some type of downside movement, which should easily have the NASDAQ down at the big fat round number of 300, right? So right in between the 382 and the 236 retrace. So right in between there. And it should come down, retest, touch, hang around with the 100 and the 200-day period moving average. You can either, I'm probably going to take some longs there. Just for a couple days or what have you, see if it'll give you some more to the upside. I don't think this market is going down right away. I do think it has some legs to it. So we'll just look at the charts and see where it goes. This is not a good chart. So the IWM and the Russell, which is actually a market leading indicator to tell you, all right, well, where are these markets really going ultimately? Maybe not right away. Right, so the QQQ and the SPY are up, while the market leading indicator, which is telling you if risk is truly on or off, which has a lot of banks, small regional banks in the Russell. So this is not a good looking chart. Below all the daily moving averages, right, and it is just making a nasty pattern. Now, this could easily fake everybody out, right? Kind of like a double bottom scenario. Go and retest all of its moving averages, as well as this breakdown candle high right here. Could easily do that, which would bring the Russell at about 190, give or take, right? 187. We just don't know at this point because of all the risk out there with the banks. But I think the market is kind of looking past the banks right now. Like we saw in 2020 and COVID, right? I mean, everybody was looking past the pandemic. The Fed, the tightening cycle is over. So you want to be on a lookout for, all right, well, if the tightening cycle is over, now everyone's kind of looking for jobless claims and a true recession. And that's not going to just melt the market down right away, right? That takes a little bit of time. And, I have no doubt, I mean, by all indications, we are already in a recession, but the bear markets that follow recessions, right, we're talking, 30+% down on the S&P 500, more so like 40 to 60, even 80% on the S&P 500. Those don't happen right away. So I wouldn't be I would not be surprised to see the S&P Go and tag, right? Go and tag those higher levels, right? Fill some of these gaps at about 430. The same on the NASDAQ. Go up and get to that 618, right? That 618 retrace, a very important 618 retrace at about 350. Big fat round number. Markets love big fat round numbers. So this would bring the IWM up a little bit more, and then you start looking for a market turn, right? You start to see, well, how many legs does this thing have? Nonetheless, it should give you some trades for a few days on the short side either way. So that's what I'm looking for, guys. On the IYT, which is the transportation ETF, also kind of like a market leading indicator. It's probably like one of my favorites. The IWM or the Russell is my first. So this is obviously showing you there's weakness, right? When everything else was melting up in 2021, I always tell people, well, look what the Russell was doing. It was just chopping. It was telling you, I'm not too sure about that. It faked you out and it showed you what the future was bringing. Now this, again, and not to go too much into detail, but this again can screw around in this area. So actually, let's do this for a second. So what happened here, right, was chopping to break lower. What's happening here is chopping to break higher, right? And that could just be the fake out. So just like this, it fakes you out, just like it did in this little loop right here, right? Chops, big range, comes up, fakes you out, and then we start looking for the real bear market that follows recessions, right? Bringing you down to 140, right? And even lower. But don't want to think about that just yet. We still got a lot of legs, in my opinion, in this market. So the transportation, this is coiling right now, the U.S. transportation ETF. You got the 50-period moving average, the 20-day, all of the daily moving averages. They're all in the same place. And you kind of have this like bullish flag type of situation here. It's closed above this breakdown candle high, right, numerous times, and now it's kind of eating time off the clock. So this would actually tell you that if this little bull pattern right here breaks up, right, goes and tests this next area right here at 234, if it goes and breaks up, then that's what it was telling you. It's telling you, hey, I'm also a market leading indicator, and I'm here to tell you that there is more upside to this. So nothing to do with it right now. I'm sitting on the sidelines, except for a little bit of a QQQ short, because it is already filling these gaps equivalent to the S&P 500, and it's already filling those gaps. And guess what? It's the most extended. So if you're gonna play the downside risk, or the downside reward, then that's your best risk right now, in my opinion. So other than that, guys, that's pretty much it on the major ETFs for the US. And then we're going over to the all-important Bitcoin. If we get some type of serious rally, Bitcoin is going to easily come back into the 37,000 range, which was this huge breakdown area. And all the way, honestly, to the big fat round number at about 40,000, right? Huge breakdown area, and it's also a Fibonacci retrace. If you draw it from the top to low right here, it's a Fibonacci retrace, and also a CME futures gap. So very important stuff. If we break up, there's no impossibility that we'll get some type of deviation, and I'll show you the deviation actually right now. So if you just draw, and it's not perfect, excuse me, but if you just draw this type of channel right here, and what I've been saying is I would actually, and there's so many plays on the ETFs, I'll probably play this too, but maybe with some options or maybe with a BITO ETF, not sure. But in any event, if we break down below, right, come tag this 200-period moving average, that's a nice deviation for a long side risk, right? And then you could just place a stop right here or right here, below this breakup candle low, right? So that would be a nice deviation. And then the short deviation, if we get some type of melt up scenario on the ETFs, that's just going to bring, it should bring Bitcoin right along with it, unless it's kind of similar to like the VIX is the new gold, or gold is the new VIX, right? So if Bitcoin's just kind of not playing along and it's foreshadowing something else, well, then that's okay. But if it's still a risk on asset and we're still going to see this type of blast off in this channel and then this deviation somewhere in here, right? This deviation somewhere in here, that is a short play. Stone cold. So I'll be playing the BIDO or maybe a centralized or decentralized exchange on the short side for Bitcoin. So watch out for those two plays on Bitcoin, guys. I think that also I wanted to show you one more thing here. This is an interesting chart just from a macro perspective. And what I want to point out here is where we're at right now with year-over-year change in the leading indicators. We are in recession territory, right? And we're not even close to a market bottom. I mean, I think the S&P, the max extension was about 25% down so far this year. And we could just check that out right now. Let's see where it was. So we take a measuring tool, right? We're right about here to here, right? So 27%. So the max correction is like 30% on the S&P 500. Obviously, this was massive. But anywhere between 20 and 30% on the S&P 500 is still considered a correction in my book. Anything sustained below 30% is a recession. So I'm looking at this and going, okay, well, what did we have? Where's the anomaly? Well, the anomaly was 2020, right? Where the leading indicators were all negative, but the market goes, I don't think so. And we had a melt up. Now look at what's happening here. We have the same situation as the dot-com bust, as '08. We're starting to see leading indicators going negative in that recessionary territory. However, we have year-over-year change in the S&P 500 back at the zero line, right? And so what that could tell you is we are at that point quite literally, and even on the charts, where we are looking for a break. Are we going to look for a break to the upside where, just like 2020, we get some type of melt-up scenario, or are we going to continue down south and follow those leading indicators down to the abyss, right? Which could be, 40, 50, 60 plus, 80% on the S&P 500, depending how bad this gets, right? Because this is very global. We have global issues right now. We don't know how bad this can get for ETFs. However, that's really where we are. I mean, look at where we are. So zero line, and then we go in here on the S&P 500, and we are literally at the 50% retrace on the daily chart. So how cool that is, how technicals line up with indicators like that. I mean, we're at literally the zero line on the S&P 500. And there's nothing to do with it right now. I mean, again, I have some shorts, but nothing crazy. And you just need to look and wait for the market to give you an indication on what to do. So as always, guys, thank you for tuning in. Please subscribe to the channel if you are not already. Please like the channel if you have not already. You can follow us on Twitter for daily updates as well. And we also have a day trading channel. All the links are provided in this comment section. Please ask me if you have any questions in the comment section, or you can DM us on Twitter. Thank you, guys. Have a great rest of your weekend.